The $84 trillion mindset trap. Here's a shocking statistic that reveals everything about why being broke keeps you broke. Studies show that the average investor underperforms the S&P 500 by about 67% over time. And it's all because of one simple behavioral pattern. While the market goes up over the long term, most people consistently buy high and sell low, destroying their wealth through pure psychology. The wealthy understand something that 90% of investors never figure out. Successful investing isn't about picking the right stocks or timing the market perfectly. It's about having the exact opposite emotional response to market movements than what feels natural. Today, I'm going to show you how your broke mindset is programmed to lose money, and how to rewire your brain to think like the wealthy who profit from everyone else's mistakes. The poor mindset, emotional slave to market movements. The poor mindset operates on pure emotion, and emotions are the enemy of wealth building. When markets are rising and everyone's making money, the poor mindset experiences FOMO, fear of missing out. They see their coworkers bragging about crypto gains or meme stock profits, and they can't stand being left behind. This is when they jump in, buying at the peak when prices are highest. But here's where it gets worse. The poor mindset also panics when markets fall. They watch their investments lose value and immediately think, I need to stop the bleeding, or I can't afford to lose any more money. So they sell at the bottom, locking in their losses. This creates the devastating cycle. Buy high when everyone's excited, sell low when everyone's scared. The wealthy call this herding behavior, following the crowd straight off a financial cliff. Research shows that this emotional trading pattern can reduce returns by 2 to 3% annually, which compounds to massive wealth destruction over decades. The poor mindset treats investing like gambling, making decisions based on how they feel rather than what the data shows. The wealthy mindset, contrarian by design. The wealthy think completely differently about market movements. When everyone else is buying and prices are high, they're either holding steady or actually selling. When everyone else is panicking and selling, they're buying aggressively. This isn't just contrarian for the sake of being different. It's based on understanding that markets are driven by emotion, not logic. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This isn't just a cute quote, it's the fundamental principle that separates wealth builders from wealth destroyers. The wealthy understand that the best buying opportunities come when everyone else is scared, and the best selling opportunities come when everyone else is euphoric. Studies of contrarian investing show that buying stocks with low price-to-earnings ratios, the ones everyone else is avoiding, can generate returns of 3.64 times the initial investment over 10 years, while conventional buy what's popular strategies only return about 77.5%. The wealthy aren't smarter, they just have better emotional control and understand market psychology. The neuroscience behind buy high, sell low. Your brain is literally wired to lose money in the markets, and understanding this is crucial to breaking free from the broke mindset. Behavioral finance research shows that people feel the pain of losses about twice as intensely as they feel the pleasure of gains. This is called loss aversion, and it's why you panic sell when investments go down. When markets are rising, your brain releases dopamine, the same chemical involved in addiction. This creates overconfidence and makes you feel like you're a genius investor, leading to more aggressive buying at higher prices. But when markets fall, fear takes over and activates the same fight-or-flight response your ancestors used to escape predators. Your brain treats financial losses like physical threats. The wealthy have learned to override these biological responses through systematic approaches and predetermined rules. They don't make investment decisions based on how they feel in the moment. They follow strategies that remove emotion from the equation. This is why they can buy when everyone else is selling and sell when everyone else is buying. How the wealthy profit from your emotions. Here's what the wealthy understand that keeps them rich. Every time you buy high and sell low, someone else is on the other side of that transaction doing the opposite. When you're panic selling during a market crash, wealthy investors are buying your shares at discount prices. When you're FOMO buying at market peaks, they're selling their shares to you at premium prices. The wealthy use systematic strategies like dollar cost averaging and rebalancing that force them to buy more when prices are low, and buy less when prices are high. They set up automatic investment plans that remove emotion from the decision-making process. While you're checking your portfolio every day and making emotional decisions, they're following predetermined rules that capitalize on market volatility. They also understand that market crashes are wealth transfer events, not wealth destruction events. The money doesn't disappear. It moves from emotional investors to disciplined ones. During the 2008 financial crisis, while average investors were selling in panic, wealthy investors were buying real estate, stocks, and businesses at massive discounts. They understood that fear creates opportunity. The Contrarian wealth building system. The first step to developing a wealthy mindset is accepting that your natural instincts about investing are wrong. If something feels comfortable and easy, it's probably the wrong move. If everyone around you is doing it, you should probably do the opposite. This isn't about being stubborn, it's about understanding that markets are driven by crowd psychology. Start by implementing systematic investment strategies that remove emotion from your decisions. Set up automatic investments that buy more shares when prices are low and fewer shares when prices are high. Use dollar-cost averaging to smooth out market volatility instead of trying to time the market. Create rules for when you'll buy and sell, and stick to them regardless of how you feel. Most importantly, start viewing market crashes as shopping opportunities, not disasters. When everyone else is panicking about their 401k losses, start looking for quality investments trading at discount prices. Train yourself to get excited about market downturns because that's when wealth is built. The wealthy know that fortunes are made in bear markets and collected in bull markets. Implementing your contrarian investment strategy. Here's your step-by-step plan to break free from the buy high, sell low trap, and start thinking like the wealthy. First, stop checking your investments daily. Emotional decision-making increases when you're constantly monitoring short-term fluctuations. Set up a schedule to review your portfolio monthly or quarterly, not daily. Second, create an investment policy statement that outlines exactly when and why you'll buy or sell. This removes emotion from the equation and forces you to make decisions based on predetermined criteria rather than feelings. Include rules for rebalancing your portfolio that force you to sell high-performing assets and buy underperforming ones. Third, start building cash reserves during good times so you can invest aggressively during market downturns. The wealthy always keep dry powder available to take advantage of fear-driven selling. When everyone else is leveraged to the hilt and forced to sell during crashes, you'll have the capital to buy at discount prices. Finally, educate yourself about market history and cycles. Understanding that markets have crashed and recovered dozens of times throughout history helps you maintain perspective during volatile periods. The wealthy know that every crash is temporary, but the wealth transfer that occurs during crashes can be permanent. Breaking free from the broke mindset forever. The difference between the wealthy mindset and the broke mindset isn't intelligence or luck, it's emotional discipline and understanding of market psychology. The broke mindset reacts to markets emotionally, buying when they feel good and selling when they feel scared. The wealthy mindset does the opposite, using systematic approaches that capitalize on everyone else's emotional mistakes. Remember, every dollar you lose to emotional investing is a dollar that goes into someone else's pocket. The wealthy have built their fortunes by being on the right side of these emotional transactions. They buy your fear and sell you your greed, and they've been doing it for centuries. The great wealth transfer happening right now represents the largest movement of assets in human history. You can either be part of the 90% who transfer their wealth to the wealthy through emotional investing, or you can join the 10% who profit from everyone else's psychological mistakes. The choice is yours, but it starts with understanding that your natural instincts about money and investing are designed to keep you broke. If this video helped you understand the psychology behind wealth building, subscribe for more content that reveals how the wealthy really think about money and investing. Your financial future depends on breaking free from the emotional patterns that keep most people trapped in financial mediocrity.